The European Central Bank wrapping up its final policy meeting of the year with a host of major announcements. And here they are, while central bankers are keeping its benchmark interest rate unchanged. The deposit rate was cut to negative 0.3% from negative 0.2%. And the ECB announcing it will extend its quantitative easing program until March of 2017. For more analysis, let's get straight to London. And that's where Michael Hewson joins us. He's the chief market strategist at CMC Markets. And Michael, it's nice to have you here. What do you make of some of the developments this morning?
Yeah, good afternoon, Scott. Good morning, Scott. I think this highlights the dangers of over-promising and under-delivering. I think there'd been a wide expectation that the ECB would embark on a significant deposit cut, an expansion of QE, and an extension of QE. I think in all matters, they've actually fallen short. The deposit rate cut was less than expected. The extension of the duration was pretty much as expected, but all they've done with respect to the actual assets that they're looking to buy on a monthly basis is they've just expanded the pool of assets. They actually haven't increased the amount, and that's caught the market the wrong side, and euro dollar has gone up. And I think, I think that was probably the least. I think that was way outside what markets were expecting.
And why didn't they up the amount of monthly asset purchase? Why just extend the whole program?
Well, I think it's really about, the amount of quality assets available. I think there's been widespread, sort of incomprehension with respect to the amount of sovereign bonds that are available for purchasing. So by actually expanding the range of poolable assets, available assets, what they're able to do is actually extend the duration much more effectively. Essentially what they're trying to do is they're scraping the barrel a little bit. They're running out of top quality sovereign bonds to buy and looking to expand it to regional and local government debt to try and extend the duration further.
All right, and the ECB also sees GDP in the Eurozone to rise to 1.5% in 2015 and 1.6% in 2016. Anything to say there?
Well, I think the fact that they've revised the GDP up slightly for 2015 and 2017 suggests to me that really the markets were factoring in way too much. And certainly I think what the ECB have done sort of reinforces that. They've also slightly revised down their inflation forecast. I think the bigger concern, I think this is why Mario Draghi has tempered his QE program, is I think he could potentially be hoping that Janet Yellen takes up the slack for him by raising rates and pushing the euro lower that way.
Well, let's talk about that. I mean, does this give the Fed more of a green light to go when it meets in a week? And when I say go, I mean raise rates, because of course we didn't get more easing this morning like everyone expected.
Yes, and I think that's potentially why. Janet Yellen yesterday highlighted in the clearest possible terms that she was inclined to go for an increase in the Fed funds rate when the Fed meets in just under 2 weeks' time. So I think unless we get a significant disaster in US economic data over the course of the next couple of weeks, I think the US will go ahead and raise rates, and in the process we could actually see the euro go lower that way. And I think that's why the ECB has probably reined back its measures that it's announced today.
All right, and of course the ECB can at any time in 2016 up those monthly asset purchases. They'll have more opportunities to do so. Michael Hewson from CMC Markets in London, thank you so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.